timely, insightful, discussion and analysis of economic trends and markets. From Southern California to Sacramento, featuring business and political leaders, unique field reports. From Orange County and the campus of Chapman University, this is the Chapman Business Report.
Well, and welcome back to the campus of Chapman University, and welcome back to the Chapman Business Report. Happy 2013. I'm Pete Weitzner. I head up the broadcast journalism program, just a couple of blocks to the west of us at Dodge College of Film and Media Arts. This is our weekly show where we look at business, financial markets, and a special focus on the regional economies of Southern California. I do that through my major domo, my analyst, Dr. Adibi. For more than 30 years, has headed up the A. Gary Anderson Center for Economic Research. And boss, we want to start by looking at current conditions and two big numbers, barometers on the economy, on jobs and on GDP, growth in the economy, somewhat moving in opposite directions. Big surprise on the growth in the economy, we fell into the red. What happened?
Yeah, actually everybody expected a very weak fourth quarter.
Well, like 1.5%.
Yeah, maybe even 1%. But then what happened, it came out actually slightly below zero, negative 0.1%. Part of it is we know what happened. We expected it. Sandy had definitely negative effect on the East Coast. Production just stopped for at least 2-3 weeks. Then we had drought, that was also negative. And then, more importantly, the fiscal cliff had a little bit of a pause in inventory building. Remember, when you look at the GDP, we look at what consumers do, what investors do, what government does, and what export, happens to export. But inventory adjustment goes up and down, which is part of the investment component, and inventory shrunk significantly along with government defense spending that went through cutback.
The biggest drop was government spending.
Yes.
The biggest drop in more than 30 years.
Yes. In a way, Defense Department particularly knows that there would be some cut, and some of the federal agencies, they're going through that reduction that is expected. They're planning it. But it was more than expected. The biggest issue was inventory, because that's temporary phenomena. When people built inventory in the third quarter in anticipation of, Christmas, holiday season, and then when it came to the fourth quarter, the inventory got depleted and they didn't go out and rebuild the inventory. And that number, when it swings, affects GDP quite a bit. But overall, if you put the whole year in perspective, growth was about 2.2%. I think actually the fourth quarter, the negative number, probably gets revised a little upward. And our forecast for last year GDP growth was 2.3%. So it's very, very close, at least on an annual basis, to what we expected.
So an anomalous figure, and as you look to 2013, you look for more of the same, about 2%.
More of the same, actually, 2.1% maybe at best. And part of the reason that we're a little worried about this year, although the numbers, at least job creation, did not indicate it, is the fact that taxes have gone up, and particularly payroll taxes. Our payroll taxes, which we had a holiday for 2 years, 4.2%, and some people get confused with payroll. That's our Social Security taxes. 4.2 is becoming 6.2. You probably noticed that on your paycheck.
Simply put, if you make $50,000, you'll have $1,000 less to spend.
And there is a cap there. It hits.
And state taxes, and for some companies, will be hit by the Healthcare Affordability Act.
And sales tax in California that has gone up. I mean, not nationally. So because of these things all together, I don't expect the growth rate to be very strong, or stronger than maybe 2.5%. That's the best we can do.
We'll talk about the headwinds in a little bit, and in a somewhat perverse way, on a regional basis, there'll be some rebuilding from Sandy, and that might be a little bit of a boost.
Yeah, the Congress just approved, both House and Senate, $50 billion of aid, and that's going to help a little bit boost construction activity.
Together with $30 billion in insurance companies.
Exactly. So that should help us a little bit.
So we get to the better news from this week, which was jobs. More of the same, not stupendous, but it seems like every month we get 150,000 jobs, which is half of what we need to get back to full employment, but seems to keep the rate steady, if not tick down a bit. This time it ticked up 9.9%. And for 2012, we averaged 187,000 jobs a month.
I look at this job number. We expected a little weaker one for January. Most economists expected 180, 175,000. It came around 155,000 for the month of January. But When you go back to last year, there was significant revision. For the year as a whole, we generated roughly 2.2 million jobs versus earlier estimate, which was close to 1.85 million. So it shows that last year the job market was really doing much better than the earlier numbers suggest. And mainly the factor that was contributing to that was the revival of the construction sector and also the retail and consumer spending that really helped job creation. Now the question, looking 2013, okay, we got the first number, 155. What do we expect for the entire year? Averaging about 150, 160 per month.
Which, as I mentioned, you need 300,000 to say by the end of next year get down to 5%.
Exactly.
Which is the goal.
Yeah.
Finally, regionally, now Orange County, we've been okay. We're now below 7%, but finally California has ticked below 10%, and Los Angeles is slightly above 10, so we're seeing some regional movement, while Los Angeles as a company town does continue to lose movie production and other.
And also remember, Los Angeles is a very big region. I mean, the west side of the Los Angeles, whether it's home buying or professional business services, leisure hospitality, is doing much better. But the eastern part of the county is a drag because there's not much going on there. That's why Los Angeles behaves pretty much like what happens to the state of California. But when you look at Orange County, we're doing much better than both. Actually, we're the strongest one in Southern California in terms of job creation and unemployment rate. However, again, we're going to talk about the headwinds. We don't see a huge surge in job creation. When I say huge surge, we used to generate in Orange County 40, 45, 50,000
We're at about
jobs.
25,000
We're about 25,000. So it's steady. We're going steady but weak.
And last point on jobs, just big picture, the 2011 there were 70 cities that were above 10%, now only 47. The number of cities below 7% has gone up to 158. You have places like Midland, Texas, oil is down around 3%. I look at things like car sales. It was up 12%. It wasn't the best of years. 14.5 million, 18 million. They're driving them off the showroom
but
floors.
Look at it, it was close to 11 million when we
and
went
Orange
through
County
recession.
was a 24% increase.
Orange County, and part of it, people, we use more cars here, and we like to drive newer cars, so we buy new cars, replacing old one. And the lease phenomena is something good that helps really the car industry. When you go through a lease, automatically every 3 years, or 2 years, you have to turn over that car, and that generates quite a bit of car buying, because when they say car buying, includes lease too. But it's indicative of that consumers, at least in Orange County, still have that spending power, and part of it, don't forget, is because of the stock market. The stock market has been doing so well, and people feel much better about their saving and retirement.
As we sit here, within about 150 on the Dow of a record S&P 500 within about 30. Overbought?
Not given what the Federal Reserve is doing. Yes, it is toppy. It's getting very toppy. But remember what Federal Reserve is doing. They're pumping money into the system. $85 billion a month is coming to the system. And this money is chasing yield. And where are they going? They're going to buy dividend stocks, which were hammered down, actually, if you remember, in November and October, because people worried about the consequence of fiscal cliff. And now they got a relief that dividend is not going to be taxed as ordinary income. So they're coming back and buying the stocks, high-paid dividend stocks. It's all liquidity that drives it. Earnings have been respectable, but it's not really as strong, especially on top line. But when you look at the money, liquidity in the system, that is helping the stock market to go up. But having said this, I am getting a little worried because, again, you get to a point that you look at the fundamental. And if earning is not there, then you say, hey, should I hold these?
There is a downside to higher asset prices, especially home prices, which we're starting to get.
Yes.
And we'll get to that next time. I'm Pete Weitzner, and this is The Boss, Dr. S.C.D.